Now to our newsmaker of the morning. He is here joining us to discuss the markets, the history of economic bubbles, artificial intelligence, so much more. Bridgewater founder Ray Dalio is with us. Good morning to you, sir.
Good morning.
So you've been providing lessons for us for a very long time.
Hey guys, Jeremy from Vyudu back at it again with more creative loot for you. In this clip, we're featuring Ray Dalio, legendary founder of Bridgewater, and one of the clearest voices on how markets and bubbles really work. You're about to hear Dalio lay out exactly what causes bubbles to inflate, and more importantly, what makes them burst when everyone least expects it. This is real world stuff that can wipe out fortunes or make them. And it's got direct impact on your life, whether you're in the game or watching from the sidelines. And heads up, I'll be taking a few pauses throughout to break things down, connect the dots, and show you why, if you haven't started building your own business already, you needed to start yesterday. The stakes aren't just about investment risk. They're about freedom, security, and the ability to stay ahead when the music stops. Let's jump in and get ready to see exactly how the smart money thinks.
Bridgewater founder Ray Dalio is with us. Good morning to you, sir.
Good morning.
So you've been providing lessons for us for a very long time about economic cycles and where we are and what's going on. The big question in the market right now, because we're looking at Nvidia this morning, and I think a lot of people are waking up thinking, where's the market headed next, has been this question of an AI bubble. And I'm curious where you ultimately come down. Are you with Jensen Huang, who says he doesn't see it that way, or do you see something else?
There's definitely a bubble in the markets. Bubbles, what is a bubble? Right?
Okay, what is a bubble?
What is a bubble? A bubble is that there's a lot of creation of wealth from various ways, such as you decide that you're going to have sell $50 billion worth of stock and value it at $1 trillion, or you have multiples like that, and then you create the wealth that way. And then the question with all this wealth relative to money is who needs the money. So it's a matter of who the buyers and sellers are. For example, if we had a wealth tax, right, or if you had a tightening of monetary policy, then there has to be the selling of those assets, so in order to pay those things. So there's a mechanics of who owns it, is it over-owned, and so on.
Let's unpack what Dalio's really saying here and connect it straight to the main street. When Ray Dalio talks about a bubble, he's not just throwing around buzzwords. He's describing a moment where there's a ton of wealth being created on paper because valuations are sky high. People are piling in and it seems like nothing can go wrong. But the catch is that wealth isn't always real or usable. It's often pumped and pumped up by hype, cheap money, and lots of people chasing quick gains. Think of stocks bid up to crazy levels or everyone suddenly chasing AI because it's the hot ticket. When markets are loaded with all this paper wealth, the question isn't just how much money is in there, but who actually needs real money and when. That's where bubbles burst. If something changes, like a new tax, higher interest rates, or just people needing cash, the rush to sell exposes how flimsy those valuations really are. That's not just some finance story for Wall Street. It trickles down to layoffs, shrinking bonuses, small business pain, and less money circulating in your local economy. For everyday people, that means jobs can suddenly dry up. Companies tighten budgets and communities feel the squeeze. If you're working a regular job and all your chips are on someone else's business or the stock market, you're riding their roller coaster. That's where entrepreneurship is pretty much your insurance. By building your own business, big or small, you control value creation, cash flow, and your own upside. Instead of just watching the headlines and hoping things recover, you're putting yourself in a position to weather shocks, adapt faster, and even grab new opportunities when everyone else is scrambling. Now, as this video continues, pay attention to how Dalio talks about short-term reactions versus long-term risk. Most people see the wins and get blinded by fast-moving prices, but these assets are supposed to be worth something in 25 years. The truth is, nobody really knows what'll happen that far out. What matters is what people do when they suddenly need cash. That's always the real test for the system. So as you listen, don't just hear this as a market story. See it as a playbook for why building real sustainable value for yourself is more important now than ever. Because when the bubble pops, entrepreneurs aren't waiting for someone else to open the doors. They're already moving.
It's not the long-term duration of the earnings. So you think about it. Isn't it interesting that we have such a short-term reaction? It's great that what the results are, but this is it's valued as a long-duration asset. So for 25 years, the next 25 years, it's very unknown. We don't know what's going to happen, and bubbles don't happen because of good estimates of what in the future. It happens because of the need for cash. Do you sell that asset? Do you have to sell that asset for cash for some reason?
Well, that's the question, though.
So your book, I thought, did such a good example. I mean, I thought, by the way, your book is fabulous.
Oh, thank you.
But you take the 1929, and then you say, what made it go up and what made it go down? And that dynamic is the way bubbles work, right? And so if you take who has exposures, how much leverage is used, and so on, this is about 80% into a bubble that was 100% would have been 1929 and 2000.
So how much leverage do you think is supporting all of this? Because we were talking to Partsenevelis in the last hour, and she was explaining this idea that Jensen Huang doesn't see a lot of the transactions that he's been doing. We've been talking about these circular transactions where he's effectively taking an equity stake in some business, and that business is then committing to buy his chips, if you will.
Yeah.
A form of vendor financing with sort of a equity overlay, maybe, is the way to think about it. Do you look at that and say that's a problem? It's not a problem? Should we think about vendor financing in a different way? That was something that got a lot of the fiber guys in trouble in the late 90s, for example.
Yeah, I think it's an issue, but I don't think it's the main issue. I think the real issue is who owns the stock.
Okay.
Is it in strong hands? Not just one stock.
Right.
Isn't it amazing we're talking about one stock for the stock market bubble, and we're talking about for the economy bubble? So you have such a small percentage of the economy, such a small percentage of the American population in terms of wealth and so on, concentrated, and everybody in it, and in a leveraged way. In various ways, it has leverage.
When most of the money is tied up in just a handful of companies and everyone's chasing the same hot trend with borrowed cash, regular people are the ones in danger. Your job, your savings, all at risk when things turn south. But owning a business, even if it's just a side hustle, changes the game. Now you've got a real safety net. You can adapt, pivot, and make moves when others are stuck. Entrepreneurship isn't just a goal, it's your shield, your escape hatch, and your chance to win when times get tough. That's how you don't just survive uncertainty. You flip it to your advantage. When Dalio said bubbles burst because people suddenly need cash and there's too much wealth locked in with just a select few, what he was really saying is that regular people are made vulnerable by relying on someone else's system. That's because When you're just a participant and not an owner, you have no say in what happens when times get rough. So, this is why building your own business puts you in the driver's seat, giving you the freedom, control, and resilience to thrive no matter how hard the market swings. Up next, you're about to hear Dalio break down who really holds the power in the market, what he calls strong hands versus weak hands. Pay attention. Strong hands are insiders and big players with skin in the game, while weak hands are regular folks just along for the ride. He's going to show how, when times get tough, it's always the public, the weak hands, who get squeezed first, and how even legendary companies can crash if they need cash quick. Listen close, because this is where you see exactly why being an owner, having real control, and thinking like an entrepreneur puts you in a different league. Let's roll it.
What are strong hands? How would you define that?
Weak hands would be the public.
So retail investors are weak hands.
Right.
Strong hands are the owners of these companies.
Right. In other words, strong hands is that they primarily invest their own money. You don't have public, right? The weak hands is largely, let's say, a leveraged public, and all united about that. Yeah. That's one of the key ingredients of a bubble. Right. So it's not just pricing, because we have to find out. You know, your book did such a great job of looking at the wonderful companies in the 1920s, and then it enumerated how electricity came out, right, and General Electric and RCA and so on. And those companies went down 90%, not because of the economy and so on. The bubble burst first because they needed cash. So you have to understand that wealth can't be spent. In order to get money, you have to sell wealth in order to get cash to get the money to buy things. And so when that happens, bubbles burst. So bubble bursting means, let's say, a tightening of monetary policy is classic, but also something like wealth taxes can happen. For example, think about wealth taxes forcing sales of assets that you have to.
You're right. By the way, there's a proposal for a wealth tax in California right now.
Yeah, so state and national, right? State and national. I'm just trying to describe the mechanics of a bubble.
But you said we're at 80%.
Well, yes, I have a bubble indicator that goes back to 1900, and it just has a number of indicators. How much leveraging? Who has the leveraging? Is it what is the amount of money in wealth that relative to the amount of cash that needs to exist, and so on? These indicators, there are a number of them, show that we're on that chart. If I was to show you the chart, it's about 80% of where it was in those two times. That doesn't mean that that's the end of the move, okay? Because bubbles have to be pricked.
Right.
And so you can measure that there's vulnerability, a lot of vulnerability. There's a lot of vulnerability of who's holding what.
Here's my question to you about that, which is if the bubble is at this 80% range on your index or metric, there are folks, we had Paul Tudor Jones come in here a couple weeks ago, and he said, look, I think we're in October of 1999. By the way, the market would still have 40% to go. Back in 1928, Charles Merrill, who founded Merrill Lynch, told everybody, get out of the market because he thought it was a bubble. And he was right and he was wrong insofar as from the beginning of 1928 to September of 1929, stock market went up 90%. And so...
But I think that when you're looking at that, you're looking at it incorrectly, okay? What is a bubble is the definition, right? I want to reiterate, a lot can go up before the bubble bursts. A bubble is an unsustained set of circumstances. It has unsustained amount of buying. Right. It has an unsustained amount of valuation. It has, and then there's something that pricks the bubble.
Is there a way to sustain this, though?
You can't look at, don't sell just because there's a bubble. Okay? Don't sell just because of bubble. But if you look at the correlations with the next 10 years returns, when you are in that territory, you get very low returns.
By the way, JP Morgan just did a report on this that showed that if you got in at over a 23 PE multiple, typically over a 10-year period, your return is a delta between 2% and minus 2% a year over 10 years.
Yes.
Which gets to your point.
I just put out today a post on this, and you'll see the charts and if you go on that. So I think that you have to say it's unsustainable. Then you have to go to the timing. What is it that pricks the bubble, right? Mm-hmm. Typically, a tightening of monetary policy. We're not going to have that now, right? Mm-hmm. But you could have something. In other words, the need for cash.
Right.
The need for cash is always that which bricks the bubble. Because when you have wealth, you can't spend wealth.
Right.
You have to sell wealth in order to get the money to buy the things you need or pay the bills you have. That's the dumb. Right. So I think that the picture is pretty clear in that we are in that territory of a bubble. We are in that bubble territory, but we don't have the pricking of the bubble.
So here's the real takeaway. If you want to move from weak hands to strong hands, you've got to be more than just a bystander. Start thinking like an owner, not just an employee or investor. This means finding overlooked opportunities in local markets, offering services people need right now, and building out digital streams, whether that's a membership, online store, or skilled-based hustle. Keep your business lean, watch your debt, and always be ready to pivot fast as things change. Real power comes from having control over your work, your money, and your connections. Don't wait for someone else to fix the system or save your job. Put creative energy into something you own. Grow your network and stay flexible in your thinking. Partner up, solve problems for real people, and launch small but move quickly. The world rewards those who step up and innovate, not just those who wait out the storm. This is Jeremy from Vyudu Inc., and this was your Creative Loot Breakdown. Stay sharp, stay building, and make your move before the next wave hits.